All right, welcome back to another episode of How to Become a Millionaire. Thank you for tuning into the show. First off, I wanted to say thank you for coming and taking the time out of your day to watch this. I know time is more valuable than money. So thank you for showing up. I hope that you get your time's worth, not just your money's worth. This episode is going to be titled Assets versus Liabilities. Assets versus liabilities. What are they? And how to make them work for you, and how do you know what do you spend on? What should you spend on? Is basically what we're going to cover today. So the first thing that I wanted to cover is this car behind me. Is it an asset or a liability? Is it an asset or is it a liability? The answer might shock you. The answer is this is a liability. You might say, well, if I buy cars and I sell cars, they're worth amounts of money. Your home is your biggest asset, so your car must be your second biggest asset, right? Well, you're wrong, and you were lied to your whole life. But by the end of this episode, you will fully understand what an asset is, what a liability is, and what the difference are between them. So the first thing that I'll point out is that is a liability, meaning, and we're going to just play with definitions for a second. An asset is anything that puts money in your pocket. A liability is anything that takes money out of your pocket. Asset puts money in, liability takes money out. So does this car take money out of my pocket? Or does it put money in? Well, it costs me for electricity or gas if you have a car, a gasoline car, right? It takes you gas. You pay a monthly payment if it's not paid off. Therefore, it is a liability. What about a house? House is kind of tricky, but hear me out on this. So a house, does it give you money or does it take away money? The answer is it takes away money, right? You have to pay a mortgage or you have to pay a lease, right? If you rent. If the house is paid off, is it still a liability? Well, yes, because you still have maintenance and repairs, but it's not as big of a liability, right? It costs you less because you're not paying the mortgage anymore. But you have to have some liabilities. So the game that I play and that all wealthy people play is how many liabilities the least amount of liabilities that I can have, the most amount of assets, right? And if I do have a liability, my asset column pays for my liabilities. And here's what I mean by that. So, you work a job. You get a paycheck. Say that's your only form of paycheck, of pay. You need to change that, right? You need to get more assets in your asset column, because right now, the only asset that you have is your time, and you're getting paid per hour. So you need to have stocks, you need to have, dividends, you need to have, anything that makes you money, rental income. You could, rent out homes. Maybe you have, you're a musician and you get paid royalties. But you have to have stuff in your asset column. You need to have more in your asset column than you do in your liability column, okay? And as well as more in your asset and less in your liability, you need to be smart about the liabilities you have and not bamboozled like most people are. For example, right, this is how the poor spend, okay? First, they make money, okay? The government takes their portion of the money through taxes, tax withholdings, right? Then you get paid what's left after tax, right? You get paid your net, okay? Then what do you do with that net? Well, then you spend it on a car, a house. Maybe you go to the store and you buy some Jordans, right? Some shoes. Maybe you get the newest iPhone, okay? Well, then what do you have left? Nothing. So it goes from your asset column, from your assets to taxes, straight out through liabilities. Okay? What do the middle class do? The middle class are pretty similar, but they're a little different. The middle class are tricked into buying fake assets. And here's what I mean by that. You go to, say, the middle class own their home, right? They don't rent. The poor rent, the middle class own, okay? Their realtor says, you get the biggest and baddest house you can afford because it's your greatest asset. They'll tell you that. They'll say it's your best asset, your biggest asset. So then they get a new job, right? They have a job. They get paid very well for the job. But they spend all of their money, a third of their income on their mortgage. $2,000, $3,000, $4,000 house. But then, still the same process. They get paid from their asset column. They have their money taken out of tax withholdings, and they have the rest. And what do? Then they spend on their house first, their biggest asset, and then they spend the rest on their liabilities. You still see how this is backwards, right? What do the rich do? What do I do? What should you do? Here's what you should do. I make money from my asset column. Business 1, business 2, business 3. Okay? I then don't have taxes taken immediately out. I can buy things with pre-tax dollars, right? As long as it's a business write-off and I'm using it for business, I can use pre-tax dollars. Then I use those pre-tax dollars and I buy an asset. Tesla stock. Right now it's, I think, $650, and the highest I've seen is $9. So I buy a Tesla stock. And in 3 years, 5 years, however long, when it shoots up to $9, I can sell or I can, wait it out, right? But my money is working for me. I'm using my money to buy assets. And eventually, say I buy a house. This is a great example. I buy a house. I have a mortgage on a $100,000 house. I pay $600 in my mortgage. I rent it out. Okay? You're with me so far? I rent it out for $1,500 a month. Now, I have more money in my asset column, right? I'm using the bank's money to make money. More money in my asset column. And my asset column is now company 1, company 2, company 3, and house. What happens if I compound that into 5 houses? I have 5 houses, 3 companies. That's 8 assets, right? And I limit my amount of liabilities. I'm not saying don't get a house and don't get a car because you need those things, but I'm saying get a house and a car that fits your needs, not your wants, right? So I get a $200,000 house when I can afford, on paper, a $1 million house, right? Where my mortgage is $800 a month, $900 a month, depending on the interest rate, versus $5,000 or $6,000. They're both a house. They both have a roof over my head. They'll do, most of the same things. Obviously, the other one's going to be a lot nicer. But if I can make my money work for me, then I'm golden, right? A house isn't an asset till you sell it, right? This car is only an asset when I sell it, because by definition, an asset is something that puts money in your pocket. If I sell the house, does that money go in my pocket? Yes, so then it's an asset. If I sell the car, does it put money in my pocket? Yes, then it's an asset, right? So be in the business of either selling liabilities and buying assets, or buying assets and selling liabilities, right? This car right here costs me, I think, $20 a month. Costs me personally $20 a month. And that's the insurance. How, Joel? How did that car cost you $20 a month? My assets, company A, B, and C, pay for the car. It's a business write-off. I have to get to work, from work. I have to do business in it. Meet client, whatever it is, right? Meet clients. So it's a company write-off, and the company pays for it, right? And I am the driver, so therefore I have to pay the insurance, because it's not on commercial insurance. So therefore, it costs me $20 a month for this whole car. So you're asking yourself, okay, so how can I do this in my life? Number one, you need to sit down, have a discussion, and pull out, I think it's called an income outcome, or asset liability sheet, whatever you want to call it, and you list all of your assets on one side, all of your liabilities on the other side. It'll tell you how much money you have every month, how much money you spend every month, and then it'll tell you how much money you should spend every month, and where the money's coming from, right? If you only have a job, that's easy. Your money comes from your job. If you have 2 jobs, 3 jobs, 4 jobs, it'll tell you how much is coming from each job. If you have stocks, it'll tell you how much your stocks have grown and how much they've not grown, right? How much they've increased or decreased. So you need to purchase assets and not liabilities. Like, you can't kid yourself on that. Obviously, there's many, many ways of getting wealthy, and in the series and in the show, we talk about combining all of them together, right? Because it's not as simple as live below your means and save 10%. If it was that easy, everybody would do it. And you can do it technically. If you save 10% for 30 years, you'll be a millionaire, right? But nobody wants to do it for 30 years. And if you do want to do it for your 30 years, it's not because you want to do it for 30 years, it's because you've been in the discipline and the habits of doing it for so long, right? So you need to buy assets, real assets, not fake assets, and limit the amount of liabilities. So in a practical way, this is how I or you could do it, okay? First things first, I analyze everything that I've spent. Okay, I have a TV provider of Dish, DirecTV, Cox Communications, whoever, right? That cost me $200 a month. Cut. Okay, now I have $200 free. Okay, my internet, I have the best internet, and I can go down just one tier package and still stream and get everything great. Save me $50. I'm up to $250, right? I have the nicest phone, but it's about to be paid off, and I don't upgrade for another year. Saves me another $30, right? So we're up to $250, $280. $280, and say I can cut my grocery budget. Instead of getting steaks, I get steaks twice a week instead of every day. And then say that saves $20. I'm up to $300, right? $300 I've taken from my liability column. Now I'm going to put it in my asset column. I'm going to buy 3 Apple stocks at $129 a share. I'm going to, save money. And listen to this very carefully because I don't want you to get this twisted. You're going to save the $300 for 4 years, 3 years, and then you're going to, in a high interest savings account, so you're getting the most amount of interest, and then you're going to put it down payment on a house and you're going to rent it out, right? I highly encourage you to have a backup savings fund, but no more than 3 months. No more than 3 months. And why? Because money is depleting in value. Inflation goes up every year, right? So you don't need all this extra liquid funds, right? So I highly encourage you to put it somewhere else where it grows and it works for itself, but you still have that backup, that cushion, right? For example, in my life, say I have $15,000 saved up just in case anything would go wrong, right? And worst case scenario, don't do this, but worst case scenario, like literally hell is, burning over, right? End of the world apocalypse, then you can cash out your stocks, and then you have more funds, right? It takes anywhere from a week to a month depending, right? And then you have more liquid funds. But you need to make sure you're not buying liabilities and you're buying assets. You're not doing keeping up with the Joneses. And keeping up with the Joneses is a very common phrase, and a lot of people do it, right? A lot of people do it. My mom is one of them. I used to be one of them, right? I used to think I needed the best shirt, the best pants, the best shoes, the best car, right? This is a $12 Old Navy shirt. No joke. Got it on sale for like $12. There's people over here buying Gucci shirts, right? But instead of, they're wearing a $200 shirt and have, $200 in their bank account. When I could buy a $12 shirt and have $20,000 in my bank account, $50,000, $100,000, $200,000, right? So I'm not saying don't spend on yourself, and I'm not saying don't buy any liabilities. I'm saying be smart about the liabilities you choose, and you need to put your assets first, because if you can save money and put in your asset column and have it work for you, then it's not just you working for your money, it's you and your assets working for your money, which is where you want to be. If we're being blatantly honest and upfront with everybody and being transparent, if I bought $200 shirts, $1,000 pants, $1,000 watch, and $600 sunglasses, could I afford this car? Yes. But how much money would that car cost me? The answer is more than $20. You reap what you've sown. We've talked about that in previous episodes. And what I mean by that is if you reap what you sow, right? That means if you sow you sow the seeds of a bountiful harvest and you put your money in your asset column, then you're going to reap from your asset column. But if you put all your money in your liability column, then all you're going to have is people calling you, right? For money. For not upstanding people, but banks saying you can get this new credit card loan and you can consolidate your debt. You can put all of this together and pay a lower interest rate. I can get you into this car for 72 easy payments. Easy payments, that's another thing to watch out for. No money down, no credit check, and low monthly payments. Those are the 3 things that you need to watch out for, because that increases liabilities, right, in your liability column, because you're now having a monthly liability to pay for, right? It's another liability you have to pay for. But those are the magic words to get into debt, because then what happens is, life gets hard. You spend some money on some credit cards, you max them out, and then now you have to pay the minimum amount, so you're paying the most amount back in interest, right, which is more than double than what you actually paid for it. And you cut them up, you say, I'm never going to do it again, and then another hardship comes. And you're still you have too many liabilities, so you're still in the same pool, So what do you have to do? I'll tell you. You pay off the minimum credit card first, because these are all liabilities you have to assess and you have to manage. You take the smallest one, you pay it off, and you go to the next one, you go to the next one, so you feel like you have some wins under your belt. Just like Gordon Ramsay said, you go from the smallest to the biggest, right? You pay them off, and then you either A, cut them up and don't ever use them, which I don't suggest. What I suggest is you don't ever go 50% more on your credit cards. 50% is the max that you spend, and you use that money for you. You use that money to buy assets. And here's what I mean. Say you work a full-time job, but you have a side gig of selling PlayStation controllers. You use, or whatever the case may be, right? We'll use PlayStation controllers for this example. You buy PlayStation controllers with a credit card. It has no money out of your pocket. You buy them for $45, you sell them for $60. First thing you do is you pay back the credit card company, and now you have a profit. Now money worked for you that was not your money. That's an asset, right? So make sure you're open and honest about your assets and your liabilities. You assess, these are my liabilities that I can cut. These are assets that I can buy, right? You don't joke yourself in saying my house is my biggest asset when it's not. It's only an asset when it makes you money. And you be open and and conscious about those decisions that you make in life. For example, nobody uses 100% of space in their house besides a hoarder. Nobody. Think about it. If you used 100% of your space in your house, how much more could you fit in your house, right? How much more could you fit? How much more could you do with that space? And I'm talking completely 100%. Nobody uses 100%, right? So why would you buy a house that's 3 times as much for 3 times as more, as much room, but then you have 3 times as much cleaning, you have 3 times as much bills, you have insurance, right? You have all of these things that keep adding on, and then you obviously you have kids because you have the space, etc. You maybe have parties would cost you money, etc. So all I'm asking and what you need to do is watch your assets, watch your liabilities, buy assets. Do not buy liabilities, or limit the amount of liabilities you buy. Because you need a car to get to point A to point B. You don't need a Porsche, though. Right? You don't. The Toyota Corolla can get you the same place, say they're both brand new. A Toyota Corolla can get you the same place as a Porsche. Toyota Corolla might even be arguably more reliable, right? But as soon as your assets are overflowing, then you can buy nice liabilities. That's what Warren Buffett, that's what, all of the Robert Kiyosaki, that's what, all of those, Jeff Bezos, everybody that's an affluent, rich billionaire, and most millionaires, so the smart ones at least, the ones that have companies and et cetera, right? What they'll do is they'll invest their money in their asset column, whether it's a 401k, an IRA, a house, rental, properties, whatever the case may be. They'll put their money in that, and when they're making $2,000 a month, say they make that's too low. Say they make $3,000 a month at their job, but they make $12,000 a month on their asset column because of their rental income and everything like that. That's $15,000. Then they use, okay, I have $15,000 a month profit, then I'll spend $700 on a car every month, $800. And they have good credit scores at that point, right? So then you're at, 2% interest, 0%, 1% interest, 3% interest, whatever, right? And they're like, well, then I'll buy this car, and instead of costing me, $1,000 a month because I have a bad credit score, it costs me, $500 a month because I have a good credit score. I put money down, I save for it, and the assets pay for itself, right? It pays for itself. Something else pays for it besides me, right? So if you want to be wealthy, the whole point of this episode is watch your spending, buy assets, don't buy liabilities, and don't get caught up in the rat race of pleasing the Joneses, because you'll never, ever catch up. Thank you so much for watching. I definitely appreciate you being here. Stay tuned in the next episode. It's going to be a doozy. Have a wonderful day. God bless, and share this message so people can understand the truth. Peace.